SoFi investors, in today's video, I'm going to break down 5 reasons why I think the stock will double in price over the next 12 months. I know the previous 6 to 8 months have not been great for SoFi stock. It's been a bummer, but when there's a bummer with a stock you love and have conviction on, and you do your homework and everything's looking good, sounds like an opportunity to me. Let's get into the video. All right, stock market investors, if you could do me a huge favor before we start the video, hit the like button, the hype button, and subscribe to the channel. It does really help us out. If you take a look at your screen right now, here's my big dog account, 191K, up 100,000 buckaroonies over the last 2 years. If you subscribe, I'll show you all my strategies and how we got these type of gains, up 126% over the past 2 years. Between this account and my Robinhood account, we have what? 526 shares of SoFi in this account, and in the big dog account we got 6,500 shares, over 7,000 shares owned here on the channel. All right, now we're going to get into these 5 reasons why I think that this stock will be doubling in stock price over the next year and get back in that $32 range. All right, investors, let's kick off this list of 5 reasons why I think SoFi will double in price over the next 12 months. Number 1, operating leverage driving hyper profitability. Operating leverage occurs when a business grows revenue much faster than its fixed operational expenses. SoFi has crossed that critical tipping point where its initial heavy infrastructure spending is fully built out, meaning each new dollar of revenue flows straight to the bottom line. That's what we like to see. We love to see top line growth, but bottom line growth drives profitability to the next level. SoFi investors, the financial trend. Here we go. This company went from a net loss of $300 million in 23 to a surging GAAP net income of $481.32 million in 2025. We gotta love that. Profitability is accelerating insanely right now. It's something we can all get really excited about. The growth disconnect. 2025 total revenue grew 35.5%, rising from $2.64 billion to $3.58 billion. But GAAP net income expanded dramatically over the same time frame. This proves this hyper profitability kind of avenue that we are at right now, guys. It's very exciting. Valuation re-rating trigger. Okay, there's been a lot of debate about how this company will be valued moving forward. Is it going to be a SaaS company? Is it going to be valued like a bank? Is it going to be a hybrid of the two? Is it going to be its own little fintech? We don't really know how this is going to play out long term because it's really going to depend on the sustainability of the growth metrics, in my opinion. Wall Street regularly values legacy banks. Yeah. Low PE, 10 to 12 times earnings because the growth is in the single digits. If you look at any of these big banks, Bank of America, Chase, Wells Fargo, they're all growing under 10%. It's more in like that 5.5% range year over year. But SoFi, high growth tech platform, scale at 30% plus. We're still at 35% plus revenue expansion while compounding its GAAP net profit margins, currently at 13.5%. The market will shift its valuation from a bank multiple to a tech growth multiple, easily doubling the stock to reflect an EPS run rate scaling towards 60 cents plus. So if that all works out, even if we're in the middle of these two, we're seeing some considerable upside for the stock moving forward. Here are the consensus EPS estimates: 60 cents this year, 81 cents next year, and over $1 come 2028. And I wouldn't be surprised if we see $1 in 2027 and maybe $1.25 to $1.50 in 2028 with those type of numbers, guys. So that is huge for us moving forward. Now, reason number 2, the mechanics of cross-buying flywheel. So when you're at one-stop shop, once they're in this ecosystem, they could pick and choose what they want to use. They want to do SoFi Invest. They want to do SoFi Plus. They want to get a mortgage. They want to get a personal loan. And small business bank, large business banking. All these things are going to be a part of this SoFi infrastructure as we move forward, as well as the original student loans, right? So here we are. The biggest financial drain on any fintech or consumer bank is the customer acquisition cost, labeled as CAC in this model. Legacy banks spend billions on direct mail and branch upkeep to win checking accounts. And the more money that people put in these checking accounts and they have in the ecosystem, the more loans they ultimately can send out to the universe, right? So legacy banks spend tons of money on this. SoFi bypassed this by using low barrier products to acquire users cheaply, then cross-selling them into higher margin financial products. That's what we want to do. We want to get them into the ecosystem, and then this way we could use that flywheel and they could pick and choose what they want for their financial needs. So that's what we want. Low cost to get entry products like a credit card, money market account, SoFi Checking, getting into SoFi Invest, and then you could move on to personal loans, student loans, mortgages, whatever you need. So the LTV, the lifetime value to CAC, customer acquisition cost optimization. So if we get them in, very low cost, this is a great way to build this ecosystem out, in my opinion. Product densification, profit margin, moving a member from 1.5 products to 3 products triples the lifetime value of that customer, while operating expenses stay completely flat. Sounds pretty good to me, guys. I love that. Here we go. Profit margin expansion. Here we go. Over the next couple of years. Adjusted net income, 15, 18 to 20%. Adjusted EBITDA, 31%, 34%. And if we could stay consistent in the mid-30s, moving towards 2030, we'll be cooking with gas, SoFi investors, and I love that. Operating margin, here we go. Long term, they want to be in that 26.1% range. Another great opportunity for us to get in at a very good price, stock price wise, in my opinion, especially with the sell-off of, the stock's been cut in half. And I'm excited about this moving forward. That is for sure. Lowering the cost of funds via the banking charter. Okay. To issue billions of dollars in loans, financial institutions need cash, and a lot of it. The more cash they have, the more they can write in loans. Pure fintech competitors like Upstart and Affirm, they got to borrow money from warehouse credit lines or investment banks, which eats into their margins because they got to pay them a cut of the profits. So they're not going to be as profitable long term, especially with this interest rates going up and down. Are they going to stay? Are they going to lower? Obviously, all these companies will make more money in a lower rate environment. Most banks thrive when the rates are a little bit lower, more people are getting loans, and it's kind of in this situation where people are more willing to pay way under 6%, right? If we can get mortgages in that 5 to 4% range, more people are going to want to get mortgages. That's kind of how these kind of numbers work. The deposit advantage. Rather than borrowing institutional money at higher market rates, SoFi uses its $40+ billion deposit base built on high yield checking and saving accounts to fund its loan origination. So every time we're putting money into our checking account, we're helping SoFi issue more loans. And when you look at those numbers in scale and the amount of members that are in the SoFi ecosystem, they continue to grow it's crazy. It's like 1 million members per quarter. It's unbelievable. The growth has been remarkable in members in the ecosystem. And then the net interest margin optimization, we love that. NIM, loan interest rate, deposit interest rate paid. So whatever the difference is, goes right into the bottom line for SoFi. By paying retail consumers a competitive APY on deposits rather than paying institutional lenders high wholesale interest rates, SoFi captures an incredibly wide institutional grade net interest margin. So their philosophy is, I'd rather give my points to the people that bank with me than some warehouse bank. So they want to give us that little bit of extra APY in our checking and savings accounts than whatever, some crazy credit line warehouse or investment bank. So it's a win-win for people in the SoFi ecosystem. Not only if you're investing in SoFi, long term the margins will be better and the company will be more profitable, but I get a sweet ass APY in my savings account. If you sign up for SoFi Plus on the first 20 grand, it's like over 4%. which I love and I use right now. So I'm excited about that moving forward. All right, here we go. This part could be huge for SoFi moving forward. Capital, light, tech, and Web3 revenue streams. They just issued the SoFi USD stablecoin, the first bank to do that. Lending businesses are inherently constrained by capital requirements, right? This is laws and regulations set out so banks can't overextend themselves. Regulators demand banks hold specific cash reserves against every loan on their balance sheet. To break past these balance sheet limits, SoFi has scaled its tech platform Galileo and fee-based products. Galileo has been a disappointment. There's no other way around it. It's not all rainbows and sunshines and leprechauns throwing coins everywhere, guys. It doesn't work like that. Galileo has been pretty shitty, and I'll be the first one to admit it, and anyone that covers the stock will too, or they're full of shit. But that doesn't mean it's going to be like this forever. So we need to see Galileo expand its profitability. We need this investment to pay off. Right now, the investment we put into Galileo, we haven't really seen any results on the bottom line quite yet. Galileo as the financial OS. Galileo acts as the white label infrastructure powering other fintechs and regional banks, generating predictable, recurring processing fee revenue. If we could scale this and get it into hundreds, if not thousands of banks, it would be huge. Those fees would just, man, it would be Scrooge McDuck style profitability for SoFi. Will it happen? That remains to be seen. All right, stablecoin and settlement fees. As they use this SoFi USD stablecoin and these settlements happen across international and state boundaries, they get a processing fee. It'll be exciting to see how this works with MasterCard and where these profits are going to go over the next few years. I think if we start to see a lot of money coming in with these stablecoin processing fees, the sky's the limit. The expansion is unlimited across international boundaries. It's exciting. There's a lot of things to be excited about with the SoFi USD stablecoin. We'll see how it plays out ultimately. But I think Wall Street is soon going to realize how undervalued this stock is in that $15 to $16 range. The valuation impact. These segments do not require credit provisions or loan loss reserves. Because this revenue is entirely fee-based and software-based, it commands software as a service style valuations, which is considerably higher than what a bank PE is in the 8 to 14 range, right? The higher mix of tech platform revenue completely changes the company's risk profile, forcing short sellers to cover and attracting institutional growth funds. We've seen a huge amount of institutional ownership over the past year pile in all-time highs. That's a great thing moving forward, 100%. And finally, insider buying. Anthony Noto used over $1 million of his own cash to purchase stock directly on the open market. So here are the buys on your screen right now. Lavitt and Schopenhauer also bought shares 5,000 apiece with a nice little rip there at $19 and $21. Both bought pretty low valuation wise. Anthony Noto really came in almost 29,000 there and another 31,000 over the couple of weeks here in May. 16, 15, and 17 he bought a shitload of shares, tons of his own money. And the last time he did this, it was the foundation of a huge run in the stock price. We could see that happen again, and I'm really excited about that. I'm going to give you guys one bonus that I think could be interesting to look at. I don't know if it's going to have a direct impact immediately, but over the long term it will, and that's the S&P 500 inclusion. There's obviously no fixed date when SoFi will get in the S&P 500, but they met all the mathematical eligibility requirements. So the rebalancing will happen. It's the third week in March, June, September, and December. Obviously, we didn't get in March. And then this Friday is another rebalancing, the third Friday in June. So that's coming up shortly. And then there's another one in September and December. I'm more looking at the December one personally, but if it gets in before then, awesome. But I'm looking at late 2026, early 2027. So the S&P 500 doesn't want to get in a situation where they got to kick people out that they just put in. So they want to have that market cap at a certain level, and SoFi is right on the borderline. I think they're going to want SoFi to be over $20 a share and hold it for a quarter or two before they get in. So honestly, I don't expect S&P 500 inclusion till December or in March of 2027. That's kind of my thoughts on that. But either way, this is going to force ETFs that track the S&P 500 to accumulate shares of SoFi over the long term, which I ultimately love for the stock moving forward. But I don't think it's going to happen immediately. But look early, Q1 2027, I think that's when we get in. Maybe a little bit earlier, maybe a little bit later, but that's kind of where I'm at right now. Those are my 5 reasons why I think SoFi will double up over the next calendar year. Don't forget to like and subscribe. Peace.